Good afternoon, everyone, and welcome to today's edition of Trinity Talks. I'm Jo Sykes, a Senior Associate at Trinity, and I will be moderating today's session. Our topic this afternoon is Offtaker Liquidity, the RLSF and other solutions. And we have several very knowledgeable speakers on our panel today. The first is Obi Banda, underwriter responsible for renewables and power at ATI Insurance, who's also responsible for the implementation of the RLSF. And then Kaushik Ray, a partner at Trinity with extensive experience advising in Offtaker Liquidity solutions, who has worked with Obi in delivering the RLSF product. Today's session will take the format of a 30-minute presentation, followed by a 15-minute Q&A session. So please do feel free to submit your questions through the Q&A function, and we'll look to deal with as many of those as possible at the end. So without further ado, I will hand over to Kaushik, who will be starting our presentation.
Hello, everybody. Thank you for joining this edition of Trinity Talks. Thank you, Jo, for that introduction. And I'm delighted that Obi Banda from ATI, the African Trade Insurance Agency, is joining us today to talk in particular about the Regional Liquidity Support Facility, the RLSF, and more widely we're going to talk about off-taker liquidity in general. So when we're thinking about off-taker liquidity, what we're really talking about is one risk, one type of risk. I think it's worth just contextualizing what we're doing. There are several risks that are associated with doing independent power projects in emerging markets. Set out here a list of those risks. You will, for those of you who are working in the power sector, particularly in emerging markets and particularly in sub-Saharan Africa, where a lot of our practice is based, you'll be very familiar with this list. And each of these risks and each of these sort of categories of risks are dealt with in different ways. The old adage that risks are best kept with the parties who are best able to deal with them is true. And very often that means that things like political risk, expropriation and so forth will sit firmly within government. And that's normally under some kind of concession agreement, implementation agreement, guarantee government support agreement, something like that. The risk that we're talking about is pretty much the most basic of them all, payment risk. So you as a developer or as a lender to a project have expended a large amount of money, a large capital cost to build a power plant, be it a thermal plant or solar or wind, what have you, and on a monthly, quarterly, semi-annual basis, there are costs that need to be paid, be they operational costs, be they debt costs, and so forth. The only way, and this is a little bit of Project Finance 101 to just contextualize the topic, the only way that that payment is going to be made is if you are receiving money from the relevant government utility or relevant private sector utility in some cases, who's paying for the electricity that you've produced. Now, in most countries, and let's talk about sub-Saharan Africa, most jurisdictions, the off-taker, the utility, is part of government, i.e. it is 100% government owned, very often as a private entity. In some cases, there is private sector involvement within that utility as well, but by and large, they are government entities. What do developers and what do lenders need then, really? Because you're producing the electricity, it's being sold, you're hoping that each invoice that you send is going to be paid. Typically, what's done is a three to 6 months worth of invoice payments. So that can be sort of a number, that's an assumed number based on a financial model of what 3 to 6 months of revenue looks like. That amount of cash will need, in some respect, to be reserved. And we'll talk at the end about a number of other potential options for how that's done. But very typically that is either kept in an escrow account, just kept quite literally sat in a bank account, usually of the utility itself, but potentially secured for the benefit of the project company. Or very often it can be a letter of credit that is issued by the utility in favour of the project company. So the beneficiary of that letter of credit would be the project company in respect of 3 to 6 months worth of invoices. There is a little bit of an issue here. And so if we just move to the next slide, we can go into a bit more detail about what those sort of issues are. The first one is a lot of off-takers simply aren't creditworthy, and that's for a number of reasons. Part of it is they're public sector entities. They maybe don't have the resource, the support internally from government, both financial support and staffing. Sometimes it's undercapitalization. In a lot of sub-Saharan African countries, as in other emerging economies, there's huge amounts of economic growth, economic development, and utilities often are playing catch up as more and more consumers come onto the grid. Then there are more and more consumers then to handle. So taking a step back, what are we really talking about? Why might the utility or off-taker not have enough money? You have to follow the money, and the way to follow the money is to look at who's actually paying the bill. So it's citizens, it's you and I who, when we pay our electricity bills, it is factories, companies, industrial users, all of those entities. So we have to track whether those entities are actually paying. When we looked a few years ago in Ghana at the payment record of the collection record, I should say, of ECG, it turned out that actually the largest non-payers were some government entities. And so part of a kind of, from a policy perspective, part of the plan is always to ensure that collections can be bettered. Some of that solution may involve, for example, putting in meters and prepaid meters in some instances to ensure that to ensure that the end users are ultimately paying. And then within the utility itself, these are relatively complicated cash management issues. So particularly where you've got that economic growth and a huge number of additional consumers, you might not have had the corresponding support from government to build up the capacity within the utility. There may be a number of you who are watching who are from institutions, whether that is a World Bank or a European Commission funded, or a government European or US or other government funded institution, who from a policy perspective is providing support for utilities, support in terms of cash management policies, training, capacity building, and so forth. All of that can happen in parallel. But in the meantime, you're left with the issue that as you're putting on more and more independent power projects onto the grid, how are you going to pay for them? And more importantly, how are you telling your developers and the lenders to those developers that you're definitely good for the money and that you have some reserves and some good financial standing to be able to pay? Previously, for a number of utilities, it was possible to look in the local market for letters of credit. KPLC, for example, and a number of early IPPs did issue letters of credit to those institutions via a commercial Kenyan bank. Unfortunately, what happens is if you are an issuing bank, all banks, all financial institutions issuing letters of credit have capital requirements. They need to know that there is either some form of cash collateral behind that, or that they're otherwise taking a good view on the financials of that institution. At some point, after a couple of LCs are issued, that runs out, and the utility is no longer able to tap the local markets for those letters of credit. One of the other options is to have a reserve account, an escrow account. unfortunately, as you'll all be aware, it's a very inefficient use of money to just keep cash sat in an account, because that cash is earmarked, it's ring-fenced for a particular purpose that may never happen. It may never need to be used. And so for 15 years, you've then got a pool of cash that sat somewhere earning probably little interest and really otherwise not doing very much, which is why cash solutions are not always the best. So from the Trinity perspective, we'd identified this as an issue in a number of countries, and there are all kinds of weird and wonderful solutions that you can attempt to put into place. There are products available in the markets. There are the World Bank has a PRG product. We'll talk about it a little bit later, that seeks to address this issue. As I said, there are escrow accounts and so forth. There are cash solutions at project company level. But we certainly felt that there was a little bit of a gap. And in conversations with KfW, the German development agency, who were looking to utilize their funding for policy objectives, the RLSF, the Regional Liquidity Support Facility, was created under the auspices of ATI, the African Trade Insurance Agency. Now, Obi will talk in more detail about what the RLSF does and how it's made up. But really, the point here is that all you're trying to do here is buy a little bit of time. We're talking about liquidity, so really some protection for 3 to 6 months, where if the off-taker is in a situation where it's not able to, for whatever reason, make a payment, you as a project company or either as a shareholder or as a lender who's looking at that revenue stream knows that that's okay, utility, fine that you might be a month or two late because I've got a solution to back that up. It's in everyone's interest. It's also in the off-taker's interest to know that that 3 or 6 months is there. The very important thing to note is the underlying obligation of the off-taker to make that payment doesn't go away. So whatever product you put in place, say it's an LC that you put in place, if that LC is called, it doesn't mean that the off-taker is off the hook. Effectively, what this LC does and what the RLSF backed LC does is it provides that buffer period where the project company is able to continue working and pay its OPEX and its debt service because it has the cash, whilst waiting for the off-taker to kind of get its act together. In some circumstances, that off-taker payment will be backed by a government guarantee. Not in every case, but in some cases that will be the case, or there might be a wider sort of termination protection or termination product that's available if it's a really bad scenario. So it's an important thing to note in a lot of these products, but specifically in the RLSF, that the risk that's being addressed is that delay in the payment, and so the obligation remains. But let's do a bit of a deeper dive into the RLSF itself, and for that I'll turn to my colleague Obi Banda from ATI.
All right, thanks so much, Ashik. That's a very helpful intro. Before I get into the details of RLSF, it would probably be helpful just to share a few notes on ATI as an institution, particularly for those who've joined the webinar and may not be very familiar with ATI. I hope you can hear me. Sorry, I think I had a challenge with my mic. I was just saying, before I get into the details of RLSF, it could be helpful to share a few notes on ATI, particularly for those on the webinar who are not very familiar with the institution. We are one of the largest DFIs on the African continent. As at the end of 2019, our entire exposure was over $6 billion, about 6.4, and we expect to have similar exposure at the end of this year, or slightly more, in spite of the challenges that we've had in view of COVID-19. We are rated A stable by S&P and rated A stable as well by Moody's. The beauty with those ratings is because of the nature of the products that we provide, we are able to support financial institutions and support institutions such as the off-takers in the power sector that may not have a credit-worthy rating similar to that of ATI. In addition to that, we on average underwrite about 1 to 2% of the GDP in our member countries, and that has been the case in the last few years especially. One of the key factors, one of the key benefits that is in place in working with ATI is we are a preferred creditor in our member countries. What that means is in the event of any challenges or defaults by a sovereign or sub-sovereign entity, we are able to make preferred recoveries from those particular governments. The key documents that underpin that are that as and when a country is joining ATI to be a member, they sign a treaty, a participation agreement, and they pay equity into the institution. So all 18 of our current member countries have gone through that process. And in all 18 of those member countries, we are a preferred creditor. We expect that membership to grow in the coming years, and hopefully at some point we'll be able to cover most all of the continent. In terms of what we do on the product side, we essentially offer on one hand political risk insurance. In addition to that, we offer trade credit insurance or commercial insurance on private and public obligors. In addition to that, you can also look at performance risks. On the performance risks, we don't underwrite as much as we do with political and credit risk. Reason being, there's so much capacity that has been developed in the local markets by local insurance companies. Worth emphasizing that as ATI, our role is to complement existing insurers in those countries without being viewed as an institution that's either taking business away from local general providers. So think of us as an institution that was set up to help bring in foreign direct investment into African countries, but additionally to help bring capacity to local markets where local underwriters may struggle to provide some of these products. If not struggle for the product, they may struggle to bring to the table the kind of rating that ATI does. If you look at the next slide, you'll see a breakdown, a good guide on where we are fully operational. The countries that are in blue are existing ATI member countries. Those that are in orange and yellow are countries that are either very close to completing their membership, and those countries that we expect to complete their membership in the next year or two. As you can see from the right-hand side, most of our membership for a very long time was focused on East and Southern Africa because we were founded under a COMESA initiative, and most of our membership came from the COMESA member countries. We are headquartered in Nairobi in Kenya, and most of the other members, as you can see, initially from when we were founded in 2001 were in East and Southern Africa. We have slowly expanded across the continent, mainly into West Africa. In the last year or so, we've had Ghana, Togo, and Niger come on board. And we expect that in the next 1 or 2 years, the likes of Mali, Senegal, Burkina Faso, and Cameroon will likely complete their membership. Part of that is being financed by partners such as KfW and the European Investment Bank, whilst in some other cases, some of the countries are able to either use concessional funds available to them to pay their equity into the institution. What we expect is in a few years' time, you will likely have a lot more blue on that map, and hopefully we can then extend our products to even more African countries. I think from here we can now go into the details on RLSF, which is the main purpose of this particular webinar. So Kaushik gave a very good introduction in terms of what the gap is with liquidity coverage on the African continent. Most utilities, as Kaushik highlighted, struggle to either provide the underlying collateral, or if they can provide the collateral, it's not exactly the best use of their funds. Alternatives in the markets have their limitations, and of course we'll touch on that towards the end of the webinar. In terms of the RLSF, what's important to note is firstly how it's structured. It's pretty much split into two parts. On one hand, you have a letter of credit, which will be issued by a commercial bank selected by ATI, and supporting that letter of credit will be an underlying guarantee or cash collateral that ATI will provide for the benefit of the LC bank. As a client, essentially as an SPV, what you then get is a letter of credit from a commercially viable institution backed by an A-rated guarantor in ATI. For the off-taker, the requirement would ordinarily have to provide cash collateral will be taken away because ATI with our partners will provide the collateral for that LC to be issued. In the first phase of RLSF, what will happen is the LCs will be issued by ABSA South Africa. In certain jurisdictions where ABSA is unable to issue those LCs, they can issue them through a correspondent bank. We haven't faced one of those scenarios yet, but it's something that we've provided for, particularly as we grow across the rest of the continent. In terms of the collateral provided, it's in the form of either cash collateral, which is financed by the German government through KfW, and you have on-demand guarantees to supplement that from ATI. The entire portfolio size is essentially 31.6 million euros worth of cash and 31.6 million euros worth of on-demand guarantees. It sounds like a lot of cash, but that can make a huge difference for small and medium-sized power projects. When you look at how the policy itself is structured, we essentially are looking to support projects of up to 50 megawatts, and in exceptional cases up to 100 megawatts. The general reasoning behind that being that if you look at larger projects, they'll probably eat up a lot more of that collateral, and you then have less to support additional initiatives. Typically, if you're looking at a project of 5-6 megawatts, 6 months of revenue will essentially be about $2 million or less, and that's something that we can structure perfectly under RLSF. The coverage itself will typically replace or complement any existing coverage that the off-taker would have provided to the IPP. So that will typically take the form of 3 months of non-payment or up to 6 months of non-payment. There are some markets where we've extended or provided the possibility to provide RLSF for up to 9 months of non-payment, but that's more of an exception. Our expectation is most of our policies will provide coverage for 3 to 6 months of non-payment. The key beauty with RLSF is that you're essentially covered for 3 or 6 months of non-payment. The collateral is provided by ATI and our partners, but it is a revolving letter of credit. So in year 1, you can put in a drawdown or claim the full amount available to you as an SPV, and ATI will then engage the off-taker and the government to make those recoveries. Recoveries are made, the initial letter of credit will be reinstated to the full value of the recoveries that have been made, and then you can then draw down in subsequent years. The policy can be issued for a tenure of up to 10 years and extended thereafter to cover a much longer period of your PPA. From ATI's perspective, when you look at the projects to support, one key requirement is this particular facility is only open to renewable initiatives or renewable projects. So we can cover solar, hydro, wind, geothermal projects, but unfortunately, the liquidity coverage is not available to non-renewable assets. In terms of the due diligence required, as an institution, we partner a lot with a lot of other DFIs that are active in the sector. So there is a lot of information sharing to inform our due diligence, but on a case-by-case basis, what we'll rely upon is due diligence on the project itself. So we'll look at the KYC aspect, we'll look at how the project is structured. Very importantly, we'll look at the tariff involved in that particular PPA. Is there deemed energy or not? Because all those have a bearing on the likelihood of a claim under our policy and the ability of ATI to recover thereafter. In terms of timelines, we try to carry out our due diligence over a period of 4 to 6 weeks. Then thereafter, it can take a bit longer to agree on the actual policy documents and the contracts, depending on the kind of queries or adjustments requested by the lenders or the SPV. But we're very confident that this particular product will make a huge difference. And we have already seen that by supporting the very first project in Burundi, we are about to support the very first solar PVs in Malawi, and we expect to extend that support and coverage across most of the continent. Moving on to the next slide, I'll try to go into a bit more detail on the underlying structure itself. So I'll ask all the viewers to focus on the bottom part of that screen, the part that's circled in red. You have RLSF at the top, and essentially you have a split between a first loss layer, which is the cash collateral, up to 31.6 million euros worth of cash, and the second loss layer, which is the ATI guarantee. One aspect complementing that is that the LC bank that has been selected by ATI has the option to retain part of the risk on their balance sheet. So let's assume you have an LC of $1 million that's to be issued. Ordinarily, $1 million worth of collateral will be provided by ATI, either cash or on-demand guarantees. But with the LC bank having the option to take up part of that risk, it allows us then to free up a bit more capacity for additional projects. Between the SPV, ATI, and the LC bank, you will have some contracts that will be signed. On one hand, it will be a letter of credit issued by the bank, and the guarantee, which the SPV will be party to, issued by ATI. Lenders can give their input on those documents before they are signed, but typically what we expect is the policy will be entered into between the SPV, ATI, and the LC bank, ABSA for now. In some cases, if required, that policy can be assigned to a particular lender, but essentially the idea is this is revenue going into the SPV. As such, the coverage should be for the benefit of the SPV. Once ATI or ABSA has made out the payment to that entity, they can then pass it on either through the equity dividends they have to pay out or through debt repayments on their facilities. So think of this as a solution for the SPV. On the left-hand side of this screen, you'll see some of the agreements we have in place with the government. One key agreement is obviously the country being a member of ATI. So you have done a treaty, you have a participation agreement in place, and you have equity that's been paid in by that government. For the purpose of RLSF, what we ask for as well is a memorandum of understanding, which will be signed between ATI, the Ministry of Finance in that country, the Ministry of Energy, and the power utility. There are no additional legal obligations brought on by this particular document, but the idea is you are looking at a product that, quite frankly, is a higher risk than most other products that ATI would provide. And the intent of this MOU is to ensure that all the parties are familiar with the requirements and obligations that ATI is taking on behalf of the off-taker and the government. If there's a loss, having that MOU in place means we're able to engage the governments in a more proactive manner, and we're able to get responses and hopefully recoveries in the event of a claim much more quickly. On a case-by-case basis, what we expect to do as well is, after due diligence has been done on any given project, we usually write to the Ministry of Finance seeking their no objection. So that again gives the project and the lenders and developers involved in that project a bit more additional comfort in knowing that the Ministry of Finance and the ministries that are involved in the power sector in that country are aware of ATI's involvement in the policy. If there's a default by the off-taker, we will engage the off-taker. If the off-taker is unable to reimburse ATI, we will then engage the Ministry of Finance. Worst case scenario, if all those means fail, we have ultimate recourse on that country's equity into ATI, which I made reference to when the country is becoming a member. So that's essentially what you have in terms of a structure. And on the very next slide, I'll try to run through some of the unique features of RLSF and some of the FAQs that we have in place. So number one, firstly, you look at similar products that are offered by most multilaterals will typically require that you have a counter guarantee or some form of indemnity for the value of the policy provided by that underwriter. In case of RLSF, that is not required because we are benchmarking the entire policy on the underlying contracts ATI has with that government, which are the treaty, participation agreement, and we're also taking comfort in having the MOU signed. The key emphasis on the MOU is that the government essentially commits to making timely payments to ATI if there's a drawdown, but it is not viewed as a guarantee, so it does not add to the government's debt, it does not add any additional financial obligations to the off-taker or to the government. As of today, I should highlight that we have 7 ATI member countries that have signed the RLSF MOU, that is Benin, Burundi, Cote d'Ivoire, Madagascar, Malawi, Uganda, and Zambia. And so in any of those countries, if you have a project you're looking at to benefit from RLSF, would not require a counter guarantee for that specific project. Secondly, in terms of the unique structure of RLSF, you can draw down multiple times in any given year, and provided ATI makes a recovery from the government or directly from the utility, we are able to reinstate the letter of credit for subsequent years. So what you then get is a 10-year policy that you can draw down if there are defaults or there are any delays in payments from the off-taker in year 1. ATI engages the government, makes a recovery, and then in year 2, you are then able to come back and submit more claims, which we hope will not be the case, but essentially the product is structured to accommodate. Thirdly, you look at short waiting periods. So this is meant to be commercially viable, and it's meant to address a liquidity challenge. So most products that are offered by political risk underwriters, such as ATI, typically come with waiting periods of an average about 180 days, which is about six months. In the case of RLSF, the waiting period is only 14 days, which allows for admin steps between ATI and the LC issuing bank. So that's a very short window, and we hope that gives comfort to lenders, especially that in the event of delays by the off-taker, you can easily submit a claim with ATI, and within a period of 2 weeks, you expect that there'll be a payout by the LC bank. Another key feature of RLSF, which is not something you see often, is that there are no upfront costs involved. You approach ATI, we give you a quote, or we advise you if it's a project that we can support. Thereafter, if you are looking to take up the policy, we undergo a comprehensive due diligence process. At the end of that due diligence process, subject to approval by ATI and by the RLSF Investment Committee, we then advise you on the next step in placing cover. Up to that point, there will be no upfront costs paid for the due diligence. The only costs that are payable under RLSF will be costs paid once the policy is about to be placed, which will be annual fees and potentially legal fees to structure the final policy documents. Then another unique feature is that the drawdowns under the facility that you have will be paid out from the cash collateral. So think of it this way. You are an SPV, you're invoicing 100,000 every month. You get a policy from ATI under RLSF for 6 months of non-payment, essentially a letter of credit for 600,000. If there's a drawdown on that particular letter of credit, ABSA will have the mandate or be mandated by ATI to immediately pay out under that policy. Then ABSA will engage ATI to make recoveries under the collateral provided. The recovery is being made by ABSA will firstly go towards the first loss layer that you saw in that schematic. So ABSA will benefit from the cash collateral, which goes all the way up to 31 million euros. That simply emphasizes the entire structure that the SPV is benefiting from, because there is no risk that ABSA will pay out, then ABSA will fail to recover from ATI, because this is fully cash collateralized, with the exception of the small portion of the risk that ABSA may choose to retain on their balance sheet. Those are some of the key unique features, but I'll be happy to answer some questions towards the end of the webinar. Some FAQs on RLSF. Firstly, how many invoices can we cover? We can cover one invoice if you'd like, but because we have to provide collateral for each and every LC, we need to be mindful of the maximum capping that we can provide. And that maximum capping is about 6 months worth of revenue. Second frequently asked question is, when can the policy be issued? So typically in such structures, this having liquidity product in place can be a CP for disbursement by your lenders. In that particular case, it means you may need RLSF at financial close, which may happen a year before COD for most solar PVs, but it can be much longer for larger projects or for hydro projects whose construction periods can take easily a year and a half, 2, or slightly more than that. In that particular case, the RLSF policy can be issued at financial close, and if not required at financial close, the policy can be issued at COD. That flexibility or the choice for which option to go to is open to the client. If you take the policy at financial close, you'll be charged 1/3 of the annual fees. If you take the policy at COD, you then just go on and pay the actual annual fees quoted. There is one risk though, because there's only a finite amount of collateral available. If you approach ATI in July 2020 and we have capacity available to you, and your financial close is at some point between now and the end of the year, we cannot give you the assurance that should you come back in a year or two, the policy will still be available, because this is a product that will be demanded on by other projects in our pipeline. And this is collateral that we have to spread out across all of ATI's membership. So there is some flexibility, but it's a choice to be made by the developer and the lenders whether to take up the policy at COD or much earlier at financial close. What is the indemnified percentage? As you may be aware, most policies that are provided by political risk underwriters will usually require some risk retention for the client. Typically that would take about 5 to 10%, possibly higher in certain higher risk jurisdictions. For RLSF, we're covering 100% of the invoice unless the developer chooses to take up less coverage. So if you're invoicing $1 million over a period of 6 months, you can draw down under the facility up to $1 million. In terms of timelines, I have touched on that in the due diligence. Our due diligence as an institution is quite fluid. We try to the extent possible to align our due diligence with some of the lenders involved in the project. So you can approach ATI within 4 to 6 weeks. The DD process will be advanced or in some cases finalized, and approval will be approval by ATI management and the investment committee, which typically takes about a week or 2. So 6 to 8 weeks for the entire process. Then thereafter, we engage the legal teams to help us structure the final contracts. Can RLSF be complemented with PRI cover? Yes, absolutely. So as Kaushik highlighted earlier, what you're looking at under RLSF is simply a liquidity coverage. So cover that gives you comfort that should there be defaults or delays for 3 invoices or up to 6 months of non-payment by the utility, you can draw down under the facility. But it doesn't take away the termination risk under the project, which typically will be covered in a PRI policy. So it is possible to buy RLSF from ATI and complement it with either a PRI product from ATI or a PRI product from any other underwriter of your choice. And I think from here, I'll move on to some additional FAQs that Kaushik will take up. Thanks. I think we can move to the next slide now.
Many thanks, Obi, for that very comprehensive overview of RLSF. And I think you've answered so many questions that I think the audience would have or will have. We've had a few questions come in as well, and there are some additional questions to be asked that I will answer. But I think just to sort of wrap up the context before we move to a Q&A, just to note, obviously, as I mentioned earlier, there are other liquidity solutions out there. RLSF isn't the only product we've given. RB has given a few of the kind of distinctions that the RLSF has compared to other PRG products. It's worth noting that the IBRD and IDA liquidity PRG has been used in a number of countries, a number of IPPs in Nigeria and Zambia, for example. Now comes under the World Bank private sector window and under the risk mitigation facility. There are huge amounts of funds available under the World Bank group for this type of liquidity PRG. I'm not going to do a kind of a compare and contrast advantages, disadvantages. There are advantages and disadvantages of all the products, and I think the one thing that everyone should take away is where these products are coming from public institutions, they're coming from a good place and from a good public policy perspective. And whilst there's no such thing as free money, as it will, this is as good as it gets in terms of helping support the energy sector in countries where the energy sector is still in the throes of development. African Development Bank also has a PRG product. And as also previously described, escrow accounts are a common feature in a number of IPPs, with the obvious disadvantage of the inefficiency of the cash usage. I think we'll turn to some FAQs, but some of the frequently asked questions that we've had, often from lenders who are lending to projects, I think it's worth just running through a few of those very quickly, and then we can turn to the live Q&A that we've had. So how many calls can be made in any year? The idea of the RLSF and likewise with the World Bank PRG LC product, it isn't supposed to be an overdraft facility. It's not supposed to just be for the off-taker to say, oh, I don't have money this month, tap into this every month. That's not the point of it. There should be some financial and fiscal discipline within the off-taker. For that reason, the calls on the RLSF product are limited to 3 in any year. That should be enough to meet any lender's requirements because it should tie into debt service periods quite neatly. But that's one thing that we get asked a lot. Does the PPA have to be amended? Yes, in an ideal situation, you are in the throes of negotiation of your PPA whilst also looking for these solutions. In a number of countries, in Burundi and in Malawi, where the PPAs were signed before the RLSF product had formally existed, a relatively straightforward amendment or side letter. As I noted earlier, the obligation on the off-taker to make these payments still exists. So very often within the PPA, there's an ability for the off-taker to, for example, procure a letter of credit to cover that risk. So the RLSF can be tied into that, and we have some drafting and language available for that, but obviously PPAs tend to be relatively bespoke. But yes, it might need to be amended. Are there suspension or termination rights, both of ATI and the LC Bank? Well, yes, there are. They are very, very limited. Again, this is public sector money ultimately. There's KfW money behind it, there's ATI money behind it. So everything that attaches to that money, things like ENS guidelines, things that are public policy, anti-corruption guidelines, and so forth. Clearly, that has to be followed through and flowed through. So to the extent there are breaches of those requirements, then potentially the RLSF product and the LC behind it could be suspended. And if it's a serious breach and after a passage of time, it could be terminated. But they are very clearly set out and they're mostly policy based. There is always in any letter of credit structure a potential risk that the LC bank itself goes insolvent. That obviously will remain a potential risk, mitigated a lot by the fact that there are contractual provisions that the RLSF has to go out and find a new LC bank within a period of time, but also the credit rating of ABSA, who is via the procurement of the RLSF, is the chosen LC bank, is strong and is high. It is ABSA Bank out of South Africa, so it's limited from an international ratings perspective by the country rating. And in certain circumstances where absolutely necessary, it would be possible to get a confirmation. But nonetheless, that is a general risk that can remain. What happens if there's no repayment after 12 months? Well, it's detailed in the contract what happens. Everyone wants to avoid that scenario, that your off-taker simply hasn't paid invoices for a period of 12 months. So there will be a lot of telephone calls, conversations between, certainly from ATI and the off-taker, but understandably between lenders and the sponsors at that time. The RLSF isn't a solution for termination costs and the like. It really is dealing with the short-term liquidity. So if the off-taker has repeatedly failed to make payments, then it's a bigger issue, a larger issue than RLSF. But there are circumstances in which, if the repayment happens after 12 months, then the RLSF LC can spring back to life. But that's really for detailed negotiation in the contract. Maximum tenor, I'll be talked about it. 10 years is the maximum tenor, but again, can be discussed under the specific circumstances. The idea being, after 10 years, if there's been a perfect credit record of the off-taker, you shouldn't really need any liquidity support. You should have a solid payment record to look to. So that's why 10 years from a public policy perspective of KfW, it's a transitional product, and so really it should be designed with something called the transparency tool, which is something that ATI put in place to monitor off-taker payments. That's what the 10 years sort of relates to. Agreements that ATI has with a national utility obby has dealt with that. If I could, Joe, I will turn to you to see if we have any other additional questions under the live Q&A that we can answer.
Great, thank you, Kaushik, and thank you, Obi, for a very informative presentation on RLSF and obviously some other liquidity solutions. Kaushik, to stay with you for now, one question from Simon. If a project is in liquidity squeeze due to non-payment by the off-taker, how do you think it will evaluate its options to either tap into its DSRA or to call on the RLSF? Yeah,
it's a good question. I think the answer there, it's really for the lenders, I think, to make that decision. The RLSF and the LC that's under it, it's really revenue replacement. So from a logical perspective, after the grace period has expired under the PPA, there's probably a period of discussion of a couple of weeks where everyone decides what to do, depending on the circumstances, right? Because the off-taker may say, I'm going to pay, I'm just a little bit late, don't call any LC, don't do anything like that, I will pay. And everyone could agree, yeah, we're just going to sit it out. If you're not in that circumstance and the off-taker is simply just not paying, I think from a lender perspective and also from a project perspective, yeah, call the LC. There is a short waiting period between calling the LC and receiving the money, during which time ATI will be, there is also an ATI halo effect. Obviously, ATI does a lot of business, underwrites a lot of business in its member states and in other countries across Africa. So it will, do its best to put calls into the utility and government to ensure that payments are made. And I think that revenue replacement then, falls at the top of the waterfall, pays OPEX enough to pay debt service. I think DSRA should remain as a reserve, as a kind of a later option. But that's my view, and that would be my advice to both to lender clients and actually to project clients.
Thank you, Kaushik. And Obi, we also have a question here, probably more specific to the RLSF itself, from Malik. In the case of non-payment by the off-taker after drawdown, will the LC still be replenished the following year or not?
All right. So the simple answer is yes. After a drawdown, the LC can be replenished, but there is some conditionality to it. So the conditionality is that ATI should then make a recovery from the government directly or from the utility within 12 months of making that payment. Now, if you're looking at a scenario where the project is not receiving revenue from the off-taker for a period of 12 months or even much longer, then I believe in that case, you're probably looking at bigger challenges on that particular project than mere liquidity, which is what the RLSF is meant to address. So the simple answer to Malak's question is yes. Once you draw down, we can reinstate the letter of credit, provided we make a recovery of that particular drawdown within 12 months from the date of the drawdown. I believe Vimbi Kaushik may want to add to that as well.
Thanks, Obi. I think you've answered that question perfectly, actually. Just want to say that it is a relatively new product in the market. It's been applied on a number of projects and is being applied on several more. As more and more projects close, it will become better known in the market and better known by developers and by lenders alike. If you have any questions generally in respect of RLSF, do please feel free to drop Obi or myself a line. The contact details are there up on screen. You can also, anything relating to Offtaker liquidity or structuring, always you can just ask Trinity, as we say. That is our hashtag. But certainly, please do feel free if you have any questions that haven't been answered in today's session.
Thank you, Kaushik, and thank you, Obi. Just for the benefit of those attending, if you'd like details of our upcoming talks, please do visit our website. You can sign up for any of those using the email address events@trinityllp.com. And thank you very much for attending. Thank you to both our presenters for their very informative insights into this topic. And we look forward to seeing you all again next week. Goodbye.